Hi friends, in today's session we are going to discuss about the previous year question from the area of marginal costing. So we already discussed lots of practice question related to this area. You need to keep practice those areas, okay? Then you have to go through this area. So moving to the first question, which is in December 2018, a company proposes to introduce a new product in the market. The company wants to maintain PV ratio as 25%. If variable cost of the product is 300, then what will be the selling price? So we have the information that PV ratio is 25% and you have to maintain PV ratio as 25% and variable cost is 300 and you have to calculate selling price. So when you are going through this question, and when you are this PV ratio, variable cost, these two items is given, how can you connect it with selling price? That is an important thing. And when you go with this variable cost, that equation, that is variable cost is equal to sales 1 minus PV ratio. So this is an equation which can be used, or the equations which is connected with the given information is about the calculation of variable cost, and here we have variable cost and PV ratio. So we can find sales from this question, and variable cost is given as 300 and sales value we do not know. I will just put it at selling price. Then 1 minus PV ratio is 25%. Okay. So now you have to actually selling price. Actually you have to multiply it with 1 minus 25%. So you can be like this, 300 is equal to selling price into 1 minus 25% means 75%, that is 0.75. Okay. So selling price is equal to 300 divided by 0.75, which is equal to 30,000 divided by 75, because in order to remove this decimal into 10 into 100. So into 100 again in the numerator part, that is like 30,000 divided by 75. Now you can do it with 5 6 are 30, 5 which is 50, right? So 6,000 by 50, that is equal to 400. Okay. So this is a way how you can calculate selling price from this equation. So when you have the particular information, you just go through which equation that actually I can apply in order to find. So here we have variable cost and PV ratio, and you need to find selling price. So the equation in which all these are actually there is this is about variable calculation, variable cost calculation. So that is variable cost is equal to sales into 1 minus PV, that is 300 into sales into 1 minus 25%, 1 minus 25% is 0.75, selling price is equal to here multiplication. So when you are taking the other part, it will be like division. So 300 divided by 0.75 and your final answer will be 400. Okay. So the next question is on January 2017 and the question goes like this: find out the number of units that must be sold by the firm to earn a profit of rupees 80,000. Selling price 25 per unit, variable manufacturing cost 12 per unit, variable selling cost 3 per unit, fixed factory overhead 5 lakh and fixed selling cost 3 lakh. Okay. So in this question you have to calculate the selling, okay, how much sales should be there in order to attain the profit of rupees 80,000. So coming to the equation for calculating that required sales or sales required, you can use the equation fixed cost plus desired profit divided by PV ratio. Okay. And what about this fixed cost? And if you want the answer in units, in our question, the question is given us the units, number of units. This is about if you want the answer in rupees, you can use PV ratio. But in our question, you can see that you need to calculate in units. So you have to take contribution. So you have to divide it with contribution. Fixed cost plus desired profit divided by contribution will give you sales in unit, number of units. If you are using PV ratio, you will get it in amount. So here you have to use this equation, and here the fixed cost. See, Profit is 80,000, selling price is 25, variable manufacturing cost is 12 and variable selling price cost is 3. Fixed factory overhead 5 lakh and fixed selling cost 3 lakh. So, these two are fixed expenses, fixed selling price and fixed factory overhead. Both these are fixed expenses. So, you have to add both these expenses with this, that is fixed cost will be 5 lakh plus 3 lakh. Okay. So, and what about desired profit? Desired profit is already given, which is 80,000. Now, what about contribution per unit? Contribution means sales minus variable cost. Okay, here we have the selling cost is 25 rupees. And what about the variable cost? Variable manufacturing cost 12 per unit and variable selling cost 3 per unit. So, both these are variable cost. So, you have to take both these costs, that is 12 and 3. So, 12 plus 3, that is 12 plus 3 means 15. So, 25 minus 15, which is equal to 10. So, contribution is 10, fine. So, fixed cost plus desired profit by contribution per unit will gives you sales in units. Okay. So, what about fixed cost? Fixed cost is 5 lakh plus 3 lakh, which is 8 lakh. Plus, what about desired profit, which is 80,000 divided by contribution per unit, that is 10. So, 8 lakh 80,000 divided by 10, that is 80,000 units. That is a correct answer for this question. Okay. Now, another question on November 2017 goes like, you have to choose which of the following is incorrect. Okay, you have to choose the incorrect equation from the following. The first one, margin of safety is equal to profit by PV ratio. That is correct. Like margin of safety, you can calculate with the help of PV ratio by profit divided by PV ratio. So, that is correct one. What about PV ratio? Change in contribution by change in sales into 100. Yes, change in contribution by change in sales into 100 or change in profit by change in sales into 100. You can use all these equations to find out PV ratio. So, that is also true. Then break even point in units, fixed cost divided by contribution per unit. Yes, if you want break even point in units, you can use the denominator part is contribution per unit, and if you want in rupees in amount, you have to divide it with the PV ratio. And finally, coming to required sales to earn profit, desired profit divided by PV ratio. What about this equation? This equation is wrong, because in order to find required sales, what you have to use? Fixed cost plus desired profit divided by PV ratio. So, this fixed cost is not here. So, the correct option for this question will be option D. All the other options are correct. Okay. So, the correct option is option D, because fixed cost is not actually included in this option. Now, another question. Margin of safety is given as 80,000, profit is given as 20,000, sales is rupees 3 lakh, you have to calculate fixed cost. So, how can you calculate this fixed cost? See, with the given items, that is from the margin of safety, profit and sales, you have to derive to the fixed cost. Anyway, we can't use the basic equation with regards to this area, and for that, in order to calculate fixed cost, we have an equation, that is sales into PV ratio minus profit. So, here we have profit and sales, what we need is PV ratio. So, with this margin of safety, we can calculate PV ratio. Margin of safety is equal to profit divided by PV ratio. Okay. And this margin of safety is given as 80,000 and profit is given as 20,000 by PV. So, PV ratio is equal to 20,000 divided by 80,000. 2 by 8, that is 1 by 4. PV ratio will be 25%. Okay. So, the PV ratio is 25%. Now, coming to the calculation of fixed cost, we have all the items. So, what about sales? Sales is given as 3 lakh. Then what about PV ratio, which is 25%? Now minus, what about profit? Profit is 20,000. Now 3 lakh into 25%. Minus 20,000. So now coming to the calculation, that is 3 lakh 00 cut. Then what about 3 into 25, which is 75. So 75,000 minus 20,000, which is equal to 75 minus 20, that is 55,000. So fixed cost is rupees 55,000. Okay. So from this information, firstly we have profit and sales and margin of safety. The common equation you can use for finding fixed cost is sales into PV minus profit, and here we need to find PV ratio. So for finding PV ratio, we used margin of safety as profit and margin of safety. Two items are given. So with that we got PV ratio as 25%, and the final answer for the fixed cost will be 55,000. Okay. So now coming to the last question, this is about the equation for calculating margin of safety. Profit by PV ratio, fixed cost divided by contribution, break even sales divided by sales, profit divided by sales. Anyway, we haven't discussed any of these equations, right? The only equation and the direct equation for calculating margin of safety is profit divided by PV ratio. So the correct answer for this question is option A. Okay. So in this video we have discussed about the previous year question from the area of marginal accounting and marginal costing. Okay. So these type of questions are mainly asked. This is mainly about the calculation, break even sales, margin of safety, then fixed cost, variable cost, all these are important. So you have to go through the equations thoroughly, and you need to practice. Okay. So I hope this video will helpful for your preparation. Thank you.